one of the things that you're very focused on is kind of that volatility, its relation to beta. You're basically trying to make sure you're getting paid off for, the risk that you're taking in individual stocks relative to the market. So how are you making those determinations?
It's we're not cowboys, and most of our so we're not going to have huge positions. I like to say I'd rather have a nice gain in a manageable size than a larger size that I'm going to get shaken out of. I think one of Bill's quotes was, "There's nothing worse than a sold out bull." So we'll vary our position size from 2 to 8, maybe 10%, starting small with the pilot starter position and adding to it as it's working. And then just basically start to reverse it, raise the stops as the stock goes higher. Or if we get stopped immediately, that's good. That's the feedback that you want from the market. And the leveraged ETFs, for hedging, sometimes that can keep you in names that you might necessarily otherwise get shaken out of. But we've also tracked something called balance at risk. So we know if all of our stops got hit, what the maximum downside would be for the portfolio. And knowing that and accepting that risk keeps us from panic selling out on a difficult down day in the market. And then on the flip side, not 100% investing in growth names and having that foundation in the portfolio of using the S&P 500, so that on those days when you rotate out of growth and into value, that certainly smooths the intraday equity curve. And we're big proponents of using that. It's difficult. You need to accept and embrace the fact that it's difficult to beat the S&P 500. Mm-hmm. And that's one of the criticisms of active large cap managers. But, they have to stay fully invested. So if they'd like to sell, they can't if the prospectus of their fund says you got to stay fully invested.
Yeah.
And you see constant sector rotation throughout the S&P, from sector to sector, from the growth sectors to value sectors, higher beta versus lower volatility, and by market cap. If you're getting out of the FANG type names and into the lower size names, and that's when the RSP outperforms the S&P 500. Mm-hmm. So it's a matter of identifying the trend of the overall market and then adding the active management of the individual names to outperform when the wind is at your back.
Well, and maybe you could address that a little bit because, a lot of our guests, it seems like every guest that we've had recently on the podcast has been talking about a lot of these faster rotations. Even what you said earlier. I mean, the Russell 2000 small caps, they looked good and then they kind of rolled over. This sector looked good and then it rolls over. I mean, some of it is 10-year treasury yield related.
Right.
I mean, the housing, stocks were looking really good and then they kind of got into some trouble. So when you're seeing these fast rotations, sometimes, at least with the sector ETFs, it can be really hard to make a bet because it seems like the trend doesn't last very long. And if you're a trend follower, what do you do when the trend doesn't last more than a week or so?
Yeah, and that's another reason why we're big proponents of the S&P 500 is that sector rotation, and combining that with the individual stock names when the wind is at your back is kind of the secret sauce that we've come up with. And having that big, so think of it this way: split your portfolio in half. If the S&P 500 is trending above all of those 3 time frames, we use a combination of the single, double, and triple ETFs to get our exposure to the S&P up to about 0.8 or 1. Remember, if you're fully invested in the S&P 500, your beta is a 1. So that's kind of the baseline. Mm-hmm. And and then we have different levels of exposure for that, depending on which of the, making sure that we're above all the moving averages and the slopes of the moving averages are trending higher. We've done a lot of work on this. We hired a data scientist, and there's a significant difference in the expected average daily return The best markets trend above the upward sloping 50-day moving average, and the worst markets trend below a downward sloping 200-day moving average. And also there's an impact of what is the current ATR of the S&P 500. That not a lot of people talk about that, but in the best markets, the average true range of the S&P 500 is going to be below 1% on a daily basis. Okay. In the 2022 bear market, it got up as high as 2.5% on a daily basis, and that's just a recipe for getting chopped up. So in that type of market, we're extremely defensive, especially if we're below the 200-day moving average, because that's where all those bear markets occur.
Mm-hmm. And just so people remember, because we have talked about this on the show before, ATR stands for the average true range. It's a measure that I think was at Wilder in the 70s. And basically you're just looking at how much does it move on a daily basis from the high to low, or in the case of gap ups and gap downs, you're going to use the previous day's close. And then you just average that over a particular time frame. Wilder used 14 days. If you're using market surge, we use a 30-day. There's different ways of, different time frames, but that's the concept behind it. And maybe you could also, because you've talked about beta and volatility as well, especially in relation to the S&P 500 and maybe even some of the leveraged ETFs, index ETFs. Maybe describe a little bit about what it is you're looking for. Beta. What does that mean to you, and why do you focus on it?
Right. So we I initially used to allocate portfolios based on beta, but a funny thing happened in 2021 after February, and that was the 10-year broke out, and all growth stocks got demolished.
Yeah.
And they got demolished a lot worse than their beta reflected. And I started doing some research, and we came up with something we call Revere Volatility Adjusted Beta, RVAB. And what it is you take a look at each individual name and compare its volatility to its average true range to the average true range of the S&P 500. The slide you're showing is a bunch of various well-known ETFs and where they are on this volatility adjusted beta scale. Like, for example, the S&P, as we said, it's a 1, and the baseline of its average true range is a 1. And then you can see it starts ticking higher, the NASDAQ, the leveraged products. And then if you go to the next slide, the reason why this is so important is because these names are all, these names that we invest in, these growth names, are all over the scale. This is an example of a couple months back on the IBD 50. Okay. And if people want to talk about how invested they are, I'm 80% long. Well, are you 80% long in lower volatility names, or are you 80% long in higher volatility names? Because that's going to make a tremendous difference in your equity curve intraday, as well as whether or not you've got the ability to sit through a difficult day on some of those names. Mm-hmm. Show the next slide, then.
Well, and just to describe for people that may be listening to this, our first slide when we're looking at the beta versus volatility, again, as you said, S&P 500 right there, 1 beta,
right,
1 ATR versus itself, of course. And then if you're sticking with the S&P 500, if you get a double leverage like SSO, you're going to be at 2 and 2, and
right,
a UPRO is going to be at 3 and 3. So you're kind of getting that straight line. Now, of course, you've got the Qs, which are a little bit more, you get a little bit more beta on those, also a little bit more of the ATR, so a little bit more volatility. IWM is in there too. And so you can kind of see, again, as that beta goes up, you are getting an ATR. But yeah, what you said about the IBD 50 is really interesting, because that slide really shows how, it's not a straight line. It's, you got somewhere,
right,
your beta is 1 and your volatility is still way up there, or your beta is less than 1, like Powell, I think was on this list. And, the ATR is much, much higher, which again, you would expect for a single stock. That's what you would expect. But the beta can be very, very different. And so then, yeah, continue on, because you were going to also look at the next slide with the Growth 250.
Right. So what this is a selection of the Growth 250. Again, this was taken a couple months back, but I'm only screening for stocks that have a beta of a 1 or a beta of a 2. Look how disparate their volatility is. So you can't just look at beta, and that's something we found out in the first quarter of 2021. You really need to know what the true average, true range is of the individual names you own, and then compare it to the S&P. And the back testing that we did, we tested hundreds of thousands of portfolios, and to come up with our calculation, we're taking 76% of the beta and 24% of the ATR relative to the S&P 500, and we give each ticker a score, and that score dictates how big of a position size we'll take in the individual name, and that's what and then you just add all of the scores up, and that gives you the adjusted beta for your overall portfolio.
Yeah. So we can show the next slide here, and again, you've kind of laid it out exactly how you do this calculation.
Yeah, not to get too in the weeds with math, but it really
I was told there would be no math.
You just need to know what the ATR is of the S&P 500, and the ATR is of your individual name, and then you take 76% of the beta, 24% of the ATR. Smooth the calculation. I gave an example of NVIDIA in there, and you can see what that calculates out to. And then this is actually our current portfolio in-house, Grotection. It's got a 1.79 adjusted beta. Again, the S&P 500. If we were 100% invested in the S&P 500, it'd be 1.0. If we were 100% in SSO, it would be 2.0. So we're at a 1.79 there, and we adjust the size. The target size is like a 0.15 to a 0.2. That's where we're comfortable, and that's where we tend not to get shaken out. If we
and that is for that target of 0.15 to 0.2. That's more for a single stock.
That's for a single name. So that's a combination of the position size that you take and the volatility score for it. You multiply those, and we don't want to go above a 0.2 on one of those, or otherwise we're taking on a little bit too much risk with an individual name.
So if you start seeing that out of whack, what are some of the things you can do? Of course, I'm sure you could reduce your position size, or you start looking elsewhere.
The trick is really to not let it get out of whack and just obeying the rules that we've come up with. Take your position size, set your stop, and let the market tell you if you made a good decision or a bad decision. The other benefit of using this approach with the 50% leverage ETFs with the S&P 500 is that it allows us to focus on the names that we really think are going to strongly outperform. Because why would we buy a stock that's going to do, say, 2 times, that our expectation is to do the 2 times the S&P, and our expectation is based on the historical slope of the relative strength line? Why would we take a stock that's only going to do 2 times, or we think is only going to do 2 times, when we can buy SSO and not have any single stock risk?
Right.
So in other words, why, you're much better off with the broad S&P 500, owning it. All of the rotation is handled by it, and you don't get any earnings blow-ups, or you don't get any analyst downgrades on it. And it really allows you to focus on just the best of the best names. So you don't have to say, well, I can own a Costco, it's a chugger. Well, why? Is it going to do 3 times the S&P? Probably not. Why have it in the portfolio? Or Oracle's another one. There's nothing wrong with it. The chart looks great, but it's not going to do 3 times the S&P 500. We take some starter positions in those to sometimes see if we can really catch a tiger by the tail and let them go higher. You do see that sometimes, but normally what we end up seeing is that we write down what is the S&P trading at each time we do a buy, and we're constantly comparing that return versus what the S&P is doing, so that we're not wasting our time in underperforming names.